When it comes to investing, new investors often focus too much on the stock price and the number of shares. On a weekly basis, I get questions in my inbox saying, "Mark, what are some good stocks to buy under, say, $75? And I respond with, "Why the certain price point?" The response is almost always the same. It's due to the fact that they want to be able to buy a certain number of shares. But when it comes to investing, you shouldn't be thinking about it that way. Let's look at a quick scenario. Let's say you have $500 to invest. Stock A trades for $50 per share and stock B trades for, let's say, $2,000 per share. Stock A, you can buy 10 shares, and stock B, you can only buy 0.25 shares. However, whether it's stock A or stock B, let's say both of those stocks go up 10%. It's not going to be based on the number of shares that you have. It's going to be based on the amount of money that you have invested in both of these stocks. You're going to have a 10% gain on the $500 you invested, whether that's stock A in 10 shares or 0.25 shares in stock B. I understand it could be a psychological thing where it's much better to say, I own 10 shares of a stock rather than I own a quarter of a share of stock, whatever. I understand that part. And there's also cases where some folks don't have the ability or the access to fractional shares. So I completely understand that. But also do not get confused thinking stock price necessarily defines how valuable a company is when compared to each other. Simple example, John Deere, the tractor company, trades at a share price of $370 per share. Their market cap is roughly $100 billion. Now, on the flip side, we look at Apple, which trades at roughly $165 per share. But as we know, their market cap is reaching $3 trillion with a T, $3 trillion. So don't get fixated on a share price and don't be so concerned about the number of shares that you own. Just focus on investing in high quality stocks. I go on to say this because I don't want you to price yourself out of high quality positions. Look at a stock like Google right now. Now, I know it's not a dividend stock, and on this channel we talk primarily about dividend paying stocks. But at the same time, I own a sizable position in Google in my portfolio outside of my dividend portfolio, my growth portfolio. Over the past 5 years, shares of Alphabet or Google have climbed 200%. But let's say you wanted to invest in Google, but the share price was way too high and you didn't want anything to do with fractional shares. So you decided to look at something more like AT&T. They paid a dividend and their share price was 20 to 30 bucks. Now over the same 5 years in which Alphabet was up around 200%, AT&T is down 40%. Now, I understand it doesn't always work like this, but I do not want you to price yourself out of high quality positions just because you're going to own fractional shares. Remember, it's not about the number of shares you own, it's about how much you invest. 10% on a $1,000 investment is going to be $100, whether that's 1,000 shares you own that makes up $1,000 invested or 0.2 shares that you own. It's the $1,000 that you have invested. Now, with that being said, I'm going to try and appease both crowds. Those looking for stocks trading at good valuations and those looking for stocks that are trading under a specific share price. And in today's video, we are going to talk about 3 dividend stocks that are trading under $75 per share. Now, before we get into the video, if you can do me a huge favor that really helps me out a lot and helps this channel grow, if you could just click right down there, just give it a little click, little tap-taparoo, that like button, that'll greatly help us with this channel moving forward. All right, thank you so much. Now, let's jump into the video. Hey everyone, welcome back for another video. If we haven't met yet, my name is Mark Rusin. I'm a CPA and not a financial advisor, so please perform your due diligence for any stock or ETF mentioned in today's video. Also, today's video is for educational and informational purposes only. Are you looking for a great new investing platform? Then check out M1 Finance. I use them personally myself, but right now they are running a special promotion where they are giving away $50 free for every new account that is started and funded with $100. That is a 50% gain right out of the gate. I will put a link in the description below for the M1 Finance promotion. Also, have you signed up for my weekly newsletter yet? The Dividend Investor's Edge goes out every Monday morning before the market opens and discusses a whole array of stock market topics and also dividend topics as well. So definitely sign up in that link down below. It is completely free. All right, with all that being said, let's take a look at 3 dividend stocks that trade under $75 per share. The first dividend stock that we're going to look at today is Bank of America, stock ticker BAC. Bank of America, in terms of market cap, is the second largest here in the US, behind only JP Morgan. They also happen to be the second largest bank in terms of asset class, with over 2 trillion assets on their balance sheet, and again trailing only JP Morgan. Having a lot of assets, in particular having a lot of deposits, meaning the money that you have deposited into a checking or savings account with Bank of America, makes them more prone to interest rate sensitivity. Now, if you've heard anything in the markets of late, there is tons and tons of talk of rising interest rates here in the near future, as early as next month. When the Fed decides to increase interest rates, this gives banks the green light to start charging more for loans. They're not going to give you any more on your savings account per se, but they'll be able to charge higher interest rates on any loan, which will give them what's called a higher net interest margin, NIM. And really, NIM is really the interest income that they can get less any interest that they give back to you. So the 0.0025% that you receive on your savings account, that'll be subtracted from the interest income on the money that they're loaning out. So say they give you a mortgage loan for 4.5%, but they're giving you a savings rate of 0.25%. Well, those two, the 4.5 is going to be subtracted from the savings rate. That's going to be your net interest margin in a nutshell. The Wall Street Journal had an article a few weeks back that said a 1 percentage point jump in the short and long-term rates would equate to more than $7 billion in additional revenue for Bank of America. As I said, we already know where rates are headed. They're not headed any lower. We've had a near zero interest rate environment for years now. And now it's time to start increasing those so that we can start bringing down the skyrocketing inflation that we've seen the past few months. Now that we see where the business is heading, let's take a look at the stock. Bank of America shares currently trade at a price of $45.96, and they're up 3.3% on the year and 35% over the past 12 months. In terms of earnings expectations, analysts expect the company to end the year with EPS of $3.25, and in 2023 they expect EPS of $3.80. This values the company at a forward price-to-earnings ratio of 14.2 times based on 2022 earnings and 12.1 times on the 23 earnings. I like to compare this to the company's 5-year average, which has been roughly 14 times, indicating that the current level of the stock is roughly fair value based on this metric alone. In terms of the dividend, the company currently sports a dividend yield of 1.83%, which is nothing crazy, but what I like about this is the dividend growth this company puts out. Over the past 5 years, the company has grown the dividend an average of 25.55% per year. The payout is still very low at 22%, indicating that the dividend should continue to grow at a steady clip, especially as rates increase. Looking at analyst price targets based on 20 separate ratings, Bank of America has an average price target of $52.58, indicating roughly 15% upside from current levels. The second dividend stock to look at today is Bristol-Myers Squibb, stock ticker BMY. Bristol-Myers Squibb has been a rock solid position for me of late, and if you've been following my dividend portfolio updates, and if you haven't, I'll put the link to that right up here and in the description below. But if you have been following, then you will know that Bristol-Myers Squibb is a top 5 weighting in my portfolio. Since the company bottomed in November 2021, shares of BMY have rallied over 25% as investors saw not only a strong company that was getting too cheap, but also a shift in investor focus from risk-off assets, those ultra-growth companies, to more high-quality and reliable cash-flowing investments like Bristol-Myers. Year-to-date shares are up 8.3%, which almost matches what the company has done over the past 12 months, as they have really been stuck in the mud since closing the $74 billion acquisition of Celgene at the end of 2019. During 2021, Bristol-Myers saw revenues grow 9% year over year and had strong cash flow generation. The company ended the year with $17 billion in cash on hand, even after lowering their total debt by $6.1 billion during the year. In Q4, the company announced a new $15 billion share repurchase program, which a third of that will take place here in Q1 2022, which is the period that we see ourselves in right now. Bristol-Myers Squibb has a strong legacy portfolio that is still performing quite well. But what really excites me about them is their robust pipeline, which is primed to generate significant growth in the coming years. New products are expected to deliver $10 to $13 billion in revenue by 2025 and over $25 billion by 2029, which will launch the company to new heights. In terms of analysts' earnings expectations for 2022, analysts are expecting Bristol-Myers Squibb to have earnings per share of $7.79, followed by $8.29 in 2023. This puts a forward earnings multiple on shares of BMY at 8.7 times using 2022 estimates and 8.2 times using the 2023 earnings estimates. These valuations are substantially below the company's 5-year average of 13 times price to earnings multiple. Turning our attention to the dividend, the company currently pays a dividend of $2.16, which equates to a yield of 3.2%, which is a pretty solid dividend yield. And they also have a low payout ratio of 26.8%. During the company's recent earnings release, they announced the $15 billion share repurchase program that I had mentioned earlier. And on top of that, they also increased the dividend 10%, which far outpaces the 5.6 average that we have seen over the past 5 years. The company has increased the dividend for 15 consecutive years now. Looking at analyst price targets, the analysts currently rate shares of Bristol-Myers Squibb a strong buy, yet the price target is only $70. But TipRanks often has a slight delay because I know there have been price target revisions after the company released earnings a few weeks back. I saw one price target revision as high as $94. The third dividend stock we're going to discuss today, under $75, is Realty Income, stock ticker O. Now, many of you know that I love REITs, and REITs make up roughly 15 to 20% of my dividend portfolio. With Realty Income, they are what's considered a triple net lease REIT, and they currently trade at a stock price of $66.63. So again, under that $75 threshold that we're looking at. Realty Income has been one of my favorite REITs to invest in over the years. But in 2021, I did some selling and sold out of the position when the valuations got pretty high. But so far this year, shares of Realty Income are down nearly 10%, and it has had me initiate a new position back into Realty Income. Now, I like to initiate positions and go in slowly, just due to the uncertainty that we are seeing in the market right now. We have rising interest rates. We have the Russian-Ukraine issues going on. We have high inflation with high supply chain issues, transportation costs going through the roof. So a lot of uncertainty and things to get ironed out. So if you're looking at new positions right now, make sure you go into them at smaller bits here and there and just wait for those to come down, because if you're anything like me, I never get the exact bottom. Now again, Realty Income is a triple net lease REIT, and what this means is they transfer a lot of the typical landlord costs that you might think of to the tenants. So things like property tax, insurance, and maintenance costs are all dealed and handled directly by the tenants themselves. Realty Income has produced compound annual returns of 15.1% per year since going public in 1994. The company is a top 10 global REIT and is projecting to be within the top 5 of all global REITs, and is also one of the few REITs on the Dividend Aristocrats list. The company has a very diversified portfolio of properties, and over 50% of their entire rental income is derived from investment-grade tenants, which offers more assurance to investors. Here is a quick look at the company's top 20 tenants. As you can see, a lot of the names you may be familiar with, such as 7-Eleven, Walgreens, Dollar General, FedEx, Dollar Tree, Walmart, and Home Depot, just to name a few. To say all that, the company has been a strong and consistent dividend payer. So much so that they coined themselves the monthly dividend company. Take a look at these and tell me how these are for some dividend stats. The company is about to pay their 620th consecutive monthly dividend payment. That's 620 consecutive monthly dividend payments. They have 97 consecutive quarterly increases with an average annualized dividend growth rate of 4.5% since going public in 1994. The company has paid an increasing dividend for 25 consecutive years now, which places them on that distinguished dividend aristocrat list. Currently, Realty Income pays a dividend yield of 4.44%. In terms of earnings, remember with REITs, we do not look at EPS and instead look at what's called funds from operations, or FFO. Analysts expect the company to generate FFO per share of $3.94 in 2022, which equates to a forward price to FFO of 16.9. Now, this is what really stuck out to me and the valuation of the high quality, strong management company, reliable dividend that you're getting with Realty Income. At a 16.9 multiple, this company has traded closer to between 18 and 19 times over recent history, indicating that shares are looking very reasonable at this price point. In terms of price targets, 9 analysts currently rate shares of Realty Income a moderate buy, with a 12-month price target of $76.25, implying nearly 15% upside from current levels. So there you have it, folks. 3 dividend stocks that trade under $75 per share. But if you have access to fractional shares, don't get caught up so much in the amount of shares you own. Focus on investing your money in high quality companies that have strong cash flows and strong management teams and a very bright future. And for me, I believe that these 3 dividend stocks that we went over today check all of those boxes. I hope you enjoyed the video, and if you haven't done so yet, please hit that like button down below, as that greatly helps our channel. And also consider taking a look at my dividend portfolio update from February, as well as top 5 REITs for 2022. Thanks for watching, and we will see you in the next video. Take care.